Nobody wants to hear this, but I'll say it anyway. You have less time than you think and more time than you fear. At 65, 70, even 80 years old, you're caught between two truths. The calendar says your days are numbered. Your heart says there's still so much living to do. And in that tension lives one of the most important financial decisions you'll ever make. Warren Buffett understood this. At 86 years old, he wrote instructions for what should happen to his wife's inheritance after he's gone. What he wrote shocked the financial world. 90% stocks, 10% bonds. Not for a young trader, for his wife, for someone who would inherit that money in her later years, when conventional wisdom says you should run from the market. Before we continue, understand this clearly. Nothing you hear today is financial advice. These are observations and documented wisdom from one man's life. What you do with your money is between you, your situation, and the professionals you trust. But let's be honest about what we're discussing. We're talking about the years when you can't afford to be wrong. The years when there's no recovery time, no second career to bail you out. We're talking about money that has to last. Warren Buffett spent his entire life thinking about money, and when it came time to protect someone he loved, he said 90-10. The question is why. Most people focus entirely on the numbers. They debate asset allocation, calculate returns, compare it to what their advisor told them. They miss the point entirely. The 9-10 rule isn't about percentages. It's about philosophy. It's about what Buffett learned over 9 decades of watching money move through the world. Go back to 1956. Buffett is 25. Starting an investment partnership. Right from the beginning, he establishes a principle that defines everything that follows. He tells his partners, I'm not going to tell you what to expect in any given year. Markets go up and down. But over the long term, if you stay patient and disciplined, you'll be fine. Not rich overnight, not safe from every downturn. Fine. 60 years later, when he writes his wife's inheritance instructions, that same principle is there. It's just been refined by 6 decades of watching what actually works. Here's what he saw. Inflation is not abstract. It's the silent thief that takes your purchasing power every single year. If you need $40,000 to live on today, you'll need $55,000 in 10 years. 75,000 in 20 years. Bonds feel safe because the numbers don't jump around as much. But that safety is an illusion if the dollars themselves are slowly dying. Your bonds aren't growing fast enough to keep up. Buffett watched retirees in the 1970s discover that their safe bond portfolios were being destroyed by inflation they never saw coming. So when he wrote those instructions, he wasn't being reckless. He was being realistic. 90% in stocks means 90% in the productive capacity of American business. It means owning pieces of companies that make things, sell things, innovate, and grow. It means accepting that some years will be terrible, but trusting that over time, growth will win. 10% in bonds means having enough stability to sleep at night, enough cushion to cover a few years of living expenses without being forced to sell stocks when the market is down. Notice what he's saying with that ratio. The stability is the small part. The growth is the big part. This runs counter to everything most advisors will tell someone in their 60s or 70s. The traditional rule says your age should equal your bond allocation. 60 years old means 60% bonds. The logic seems sound. The older you get, the less risk you can afford. But Buffett saw the fatal flaw. Yes, you have less time, but you also have more time than you think. If you're 65 and healthy, you might live to 95. That's 30 years. That's longer than most people's careers. You need growth, not for greed, for survival. Here's the truth. The biggest risk in retirement isn't a market crash. It's running out of money when you're 87 and there's nothing you can do about it. A market crash is terrifying but temporary. Running out of money is permanent. Buffett built his philosophy around one insight. In the short term, the market is a voting machine. In the long term, it's a weighing machine. Short term, anything can happen. Long term, value wins. If you're retiring at 65, you're not investing for the short term. You're investing for the long term. You just happen to be older while you're doing it. Traditional retirement planning treats you like you're dying tomorrow. It tries to protect you from every downturn. In doing so, it guarantees you'll slowly go broke in safety. Buffett's approach treats you like you're still alive. It says, yes, you're older, but you're not dead. Yes, be thoughtful, but don't be paralyzed. Think about what actually causes disaster in retirement. It's rarely the crash itself. It's panic during the crash. It's selling everything at the bottom because you can't stand to watch. It's making permanent decisions based on temporary fear. In 2008, the market fell more than 50%. Retirees who panicked and sold locked in those losses forever. Retirees who stayed patient saw their portfolios fully recover and grow beyond where they started. Buffett was 78 during the 2008 crash. He didn't sell, he bought. He wrote an op-ed titled, "Buy American I Am." This wasn't bravado. It was belief that over time, productive enterprise would reassert itself. Now, be very clear. The 90-10 rule isn't for everyone. If you need to withdraw money every month to pay bills, you need to structure differently. If you're starting retirement with barely enough, you can't afford the same approach as someone with more than they'll spend. If you have health issues or specific timing needs, your situation requires different thinking. But here's what the 90-10 rule offers: freedom from short-term thinking. When Buffett allocates 90% to stocks, he's not saying, take maximum risk. He's saying, take maximum advantage of what actually works over time. The real risk isn't volatility. The real risk is being so careful that you end up broke. Consider his own life. Buffett is worth more than $100 billion, virtually all of it in Berkshire Hathaway stock. At 94, he could sell everything, put it in bonds, and live in absolute safety. He doesn't. He stays invested because wealth isn't built by hiding from growth. It's built by participating in it year after year through good times and terrifying times. The 90-10 rule is ultimately a bet on your own discipline. It says, if you can stay calm through the bad years, you'll be rewarded in the good ones. If you can remember that retirement is actually a long time, you can invest accordingly. But if you're going to panic and sell during every correction, if you're going to check your balance daily and lose sleep, then 90% stocks will destroy you. Not because the strategy is wrong, but because you won't stick with it. Buffett knows this. His wife isn't a professional investor. She doesn't obsess over markets. She won't be tempted to tinker. She'll set it and forget it. That's exactly why the strategy works. Let's talk about the 10%, because it's just as important as the 90. That 10% in short-term bonds is your stability anchor. When stocks fall, that 10% doesn't. It sits there, calm and unmoved. Second, it's your spending money. You can pull from that 10% to cover living expenses without being forced to sell stocks at bad prices. If the market drops 40%, you don't sell stocks at a loss. You live off the bonds and wait. Third, it's your psychological buffer. It lets you sleep at night. It's permission to stay invested in stocks precisely because, you have a cushion. For someone with $1 million portfolio, that's $100,000. That could be 3 or 4 years of living expenses. That's enough to ride out almost any crisis in market history. The genius of the 90-10 split is that it's enough safety to enable courage. Buffett's entire approach can be summarized in a phrase he's used countless times. Be fearful when others are greedy, and greedy when others are fearful. In retirement, this translates to specific behavior. When the market is soaring, don't get swept up. Stay at 90-10. When the market is crashing, don't panic. Stay at 90-10. The discipline is in the consistency. Buffett learned this from Benjamin Graham, who lived through the Great Depression. Graham taught that the market exists to serve you, not to instruct you. Its job is to offer prices. Your job is to take advantage when they're favorable and ignore them when they're not. For a retiree with a 90-10 portfolio, this means something specific. In years when stocks do well, you rebalance. You sell some appreciated stock and move it into bonds, bringing yourself back to 90-10. You're taking profit without trying to time the market. In years when stocks do poorly, you might do nothing. Or if you need money, you pull from bonds, which naturally moves you toward a higher stock percentage. When stocks recover, you're positioned to benefit even more. This is the opposite of what most people do. Most people chase performance. They sell what's down and buy what's up. They let emotions drive decisions. They buy high and sell low. The 90-10 rule prevents this. It gives you a target, something to return to regardless of what's happening in the world. But here's what you need to understand at the deepest level. It's not about the numbers. It's about trust. Trust in human progress. Trust that people will keep innovating, building, solving problems. Trust that companies will adapt. Trust that capitalism, for all its flaws, is still the most powerful engine for creating value humans have invented. When you put 90% in stocks, you're not gambling. You're expressing faith that the collective ingenuity of millions of people working in thousands of companies will, over time, create more value tomorrow than exists today. This isn't naive optimism, it's historical realism. For more than a century, through world wars and depressions and pandemics, American businesses have created value. They've stumbled and failed and been disrupted. But as a collective whole, they've grown. Buffett has internalized this so deeply that he can stay calm when everyone else is losing their minds. In 2020, when COVID hit and markets crashed, Buffett was 90. He'd seen this movie before. Different crisis, same panic, same eventual recovery. He didn't change his approach. Within months, markets recovered. Within 2 years, they reached new highs. Everyone who panicked sold locked in permanent losses. This is the pattern. Crisis, panic, recovery, growth. The timeline varies. The specific cause varies. The fundamental cycle never does. A retiree with the 90-10 approach is betting this cycle will continue for the next 20 or 30 years. Given that it's held for the last 100, that's not a particularly bold bet. But it requires patience. When you're 30 and your portfolio drops 40%, you can wait 10 years. When you're 70, 10 years feels like forever. You start doing the math. you start worrying. This is where discipline becomes everything. Buffett talks about his favorite holding period being forever. When he buys a company, he's not thinking about next quarter. He's thinking about whether this business will still be valuable in 2 decades. If yes, the short-term price becomes irrelevant. For a retiree, this mindset is liberating. You don't have to watch CNBC every day. You don't have to react to every headline. You just have to believe that over your remaining lifetime, businesses will keep creating value. 90/10 says, I'm betting on that long-term reality, not on my ability to predict short-term chaos. There's a deeper layer here. The 90/10 rule isn't just about returns, it's about simplicity. Buffett doesn't invest in things he doesn't understand. His portfolio is shockingly simple. No complex derivatives, no exotic strategies. Just ownership in good businesses and patience. The 90/10 approach is the same philosophy. 90% in a low-cost stock index fund, 10% in short-term government bonds. That's it. 2 holdings, 1 decision per year when you rebalance. Compare this to what most retirees have. 12 different funds. International exposure and emerging markets and small cap value and real estate trusts. Complexity stacked on complexity. Each layer adding fees and confusion. Buffett looked at all that complexity and rejected it. Not because he's not sophisticated enough, because he's sophisticated enough to see through it. Most complexity in finance exists to justify fees. Study after study shows that simple index investing beats active management over time. Buffett proved this definitively. In 2008, he made a $1 million bet with hedge fund managers. He said a simple S&P 500 index fund would beat their portfolios over 10 years. They laughed. Too simple. 10 years later, Buffett won easily. The index fund returned 126%. The hedge funds averaged 36%. For a retiree, this lesson is crucial. You don't need to be clever. You don't need to find the next great stock or time the market or hire expensive advisors. You just need to be patient and disciplined with a simple approach. 90/10 is that approach. It's everything Buffett learned over 7 decades, reduced to its essence for someone who doesn't want to spend retirement obsessing over markets. Let's pause here and consider what this means for daily life. You wake up and markets are down 3%. Your neighbor calls, panicked. Your son emails an article predicting recession. Every instinct tells you to do something. With the 90/10 approach, you do nothing. You remember your strategy is designed for the long term. You remember that Buffett has sat through dozens of these moments. You remember that reacting to one day's news is exactly how wealth gets destroyed. This is harder than it sounds. Doing nothing feels irresponsible, but in investing, activity is often the enemy of returns. Buffett's track record proves this. Berkshire's biggest holdings have been held for decades. Coca-Cola, purchased in 1988, still there. American Express, bought in the 1960s, still there. This isn't laziness, it's wisdom. For a retiree with the 90/10 portfolio, this translates to perhaps one action per year, rebalancing. That's it. The rest of the time, you live your life. You spend time with grandchildren. You travel. You read. You do all the things you worked 40 years to be able to do. You don't watch your portfolio every day. You've made a sound decision based on historical reality and Buffett's documented wisdom, and now you trust it. This is the peace that comes from having a philosophy rather than a tactic. Tactics require constant adjustment. New information means new tactics. Every crisis requires a new response. It's exhausting and error-prone. Philosophy is different. Philosophy is a foundation. It doesn't change when the news changes. It just requires belief and patience. Buffett's philosophy can be stated simply: own productive assets, pay fair prices, hold forever, don't panic. That philosophy served him building a fortune in his 30s and 40s. It served him protecting that fortune in his 60s and 70s. And now, in his 90s, it's the same philosophy he's passing down to protect his wife. The consistency is the point. It works at every stage because it's based on fundamental truths about how value is created and preserved. There's something else worth understanding. He specified low-cost index funds, not Berkshire Hathaway stock, even though he believes in his own company, not hand-picked stocks, even though he's one of the greatest stock pickers in history. Index funds. This tells you something profound. Buffett knows that successful investing isn't about being smarter than everyone else. It's about avoiding stupidity. Index funds are the ultimate stupidity avoidance device. You own everything, so you can't be catastrophically wrong. You pay almost nothing in fees. You never have to make timing decisions. For someone in retirement, this is liberating. You're acknowledging that you don't need to be an investing genius. You just need to participate in the growth of the economy in the simplest, lowest cost way possible. The 10% in short-term government bonds serves the same purpose. These are as close to risk-free as investments get. The U.S. government has never defaulted. You know exactly what you'll get back and when. No complexity, no credit risk. This is Buffett's gift to his wife, a portfolio so simple that it requires almost no financial sophistication to manage, yet so effective that it will preserve and grow wealth through whatever challenges come. Consider the humility in that. Buffett could have created something complex that showcases his brilliance. Instead, he created something anyone can implement, something that doesn't require him, something that works precisely because it's not dependent on genius. This might be the most important lesson for retirees. You don't need to be Warren Buffett to benefit from Warren Buffett's wisdom. You just need to embrace simplicity over complexity, patience over activity, and discipline over emotion. The Nas 10 rule is controversial precisely because it's so simple. Financial advisors struggle with it because there's nothing to do, nothing to justify. Fees. It challenges the entire industry built around the idea that investing requires constant professional attention. But Buffett's track record speaks for itself. He's been proved right so many times that betting against his wisdom is probably the real risk. Now, let's address sequence of returns risk. This is the concern that if you retire right before a major market crash, you could be forced to sell stocks at terrible prices, permanently damaging your portfolio. It's a real risk. But the 90-10 approach handles it better than you might think. Remember that 10% in bonds. If you have $1 million portfolio, that's $100,000. If you need $40,000 per year, that's 2.5 years covered without touching stocks. If markets crash right after you retire, you live off the bonds. You don't sell stocks at the bottom, you wait. History shows that even the worst crashes have recovered within a few years. The Great Depression took about 5 years to bottom. The 2008 financial crisis recovered in about 5 years. Most bear markets resolve faster. If you can avoid selling stocks for 2 or 3 years while markets recover, you've dodged the bullet. The 10% gives you that cushion, and patience is the entire game. Buffett's investment success can be summarized in one metric. He's been investing for more than 70 years. Not 70 years of brilliant trades, 70 years of staying invested, 70 years of not panicking, 70 years of letting compound interest work. Albert Einstein called compound interest the eighth wonder of the world. Those who understand it, earn it. Those who don't, pay it. In retirement, you're in the critical phase of earning it. You've spent your working life accumulating. Now you need that accumulation to keep working, growing faster than you withdraw, staying ahead of inflation, maintaining purchasing power across decades. The 90-10 approach is designed to maximize your exposure to compound growth while giving you just enough stability to stay the course emotionally. In 1974, the market had been falling for 2 years. Stocks were down nearly 50%. Inflation was raging. The economy was in recession. Everyone was miserable. Buffett wrote to his partners that he felt like an oversexed man in a harem. Everything was cheap. Everything was on sale. He was deploying cash as fast as he could. While everyone else panicked, he was shopping. Not because he knew the bottom was in, but because he understood that when good companies are cheap, you buy them. This mindset doesn't change with age. A retiree watching their portfolio drop 40% needs to remember Buffett in 1974. That fear creates opportunity if you can control your own fear long enough to see it. The 90-10 portfolio forces this discipline. You're not asking yourself whether to be in stocks. You've already decided 90% in stocks forever. The only question is whether to rebalance. And that's mechanical, not emotional. This removes the temptation to market time. You can't sell out during crashes because you're not supposed to. You can't pile in during bubbles because you're already in. You've made the hard decision once when you set up the portfolio, and now you just follow the plan. The hardest decisions in investing always come at the worst possible times. When markets crash, you're terrified. When they soar, you're euphoric. Neither produces good decisions. The 90-10 rule protects you from yourself. It's a commitment device. It's Odysseus tying himself to the mast so he can hear the sirens without steering his ship onto the rocks. Buffett understands human psychology deeply. He knows intelligence and knowledge aren't enough. You can know exactly what to do and still fail when emotions take over. So he's designed a system that minimizes emotional decisions. One more thing. Buffett isn't afraid of volatility. He welcomes it. In his 1994 shareholder letter, he wrote about how he'd be worse off if Berkshire's stock went up every day by a tiny amount. Why? Because he uses price drops to buy more shares. Volatility in the right direction is opportunity. For a retiree, this mindset shift is essential. Volatility isn't damage, it's just movement. The damage only happens if you sell at the wrong time. If you're not planning to sell, if you're planning to hold for 20 or 30 more years, then volatility is just noise. Watching your portfolio drop from 1 million to 600,000 is brutal. But if you don't sell, if you hold through it, if you remember you're investing for the next 2 decades, not the next 2 weeks, then that drop is temporary and irrelevant. When Buffett tells his wife to invest 90-10, he's telling her, ignore the noise. Don't check it every day. Don't let short-term movements dictate your peace of mind. You've got a sound strategy based on 100 years of history. Trust it. This trust is the hardest part. We're wired to react to threats. A dropping portfolio feels like a threat. Every instinct says, do something, fix it, protect yourself. But in this case, reacting is the threat. Selling is the threat. Fear is the threat. Discipline is the protection. Buffett spent his 20s and 30s building this discipline. By his 40s, it was second nature. Now, in his 90s, it's simply who he is. For someone adopting the 90-10 approach in their 60s or 70s, you're learning this discipline later. It will be harder. The temptation to deviate will be stronger, but the principle remains. Short-term movements don't matter if your time horizon is long enough, and your time horizon is longer than you think. Even at 75, you might have 20 years. That's not short-term. That's plenty of time for markets to do what they always do: recover, grow, reward patience. Let's talk about legacy. Buffett has committed to giving away more than 99% of his wealth. He's not building a dynasty. He's using his money to solve problems in the world. But even as he's giving it away, he's still investing it, because money that's invested grows, and growing money can do more good than static money. You're not just managing money for yourself. You're managing it for your spouse, possibly for your children, certainly for your legacy. Money that grows can help more people, create more options, solve more problems. The 90-10 approach isn't about greed. It's about stewardship. It's about taking what you have and ensuring it remains valuable and productive for as long as possible. If you have more than you need, then growing that surplus through simple, disciplined investing means you can be more generous with your children, more helpful to causes you care about, more impactful with your giving. Buffett's money has always been a tool, not a scorecard. He lives modestly. He drives an old car. He lives in the same house he bought in 1958. The money exists to do things, not to impress people. For a retiree with a 90-10 portfolio, this mindset brings peace. You're not trying to time the market to squeeze out extra returns. You're simply being a good steward of what you have, letting it grow in the simplest possible way. This is abundance thinking versus scarcity thinking. Scarcity thinking says, protect every dollar, take no risks. Hold everything in cash because I'm running out of time. Abundance thinking says, I have enough. I have time. I can let growth work for me. Buffett has always operated from abundance, even when he had very little. It's a mental state, not a bank balance. It's belief that opportunities will keep coming, that the world will keep creating value, that patience will be rewarded. Adopting the 90-10 approach is adopting that abundance mindset. You're saying, I'm not going to hoard everything in fear. I'm going to stay invested in growth because I believe in the future. There's courage in that. The courage to be patient when everyone else panics. The courage to stick with a plan when your emotions scream at you to abandon it. The courage to trust processes that have worked for 100 years. Buffett's gift to his wife wasn't just an investment strategy. It was permission to not worry. Permission to trust. Permission to live the rest of her life without obsessing over money every day. That's what the simplicity enables. When you have 90% in one index fund and 10% in short-term bonds, there's nothing to monitor constantly. There's nothing to tinker with. You can check it once a year, rebalance if needed, and spend the other 364 days actually living. This is what real wealth means, not the number in your account. It's the freedom from having to think about the number in your account. Buffett is one of the richest people on earth, but he spends his days reading, thinking, and doing work he finds interesting. Not managing his portfolio minute by minute, not obsessing over daily fluctuations. He set up systems decades ago that work without constant attention. Now he lives his life. The 90-10 approach offers the same gift to anyone willing to accept it. Set it up once, trust it, live your life. So here's what it comes down to. You're at a stage where you've accumulated something, you've worked for it, sacrificed for it, worried over it, and now you face a choice. You can spend the rest of your years trying to protect every dollar, making your world smaller and smaller until fear has consumed everything. You'll be safe perhaps, but you'll also be broke before you die, and you'll have lived those final years in anxiety. Or you can adopt a strategy that's been tested across a century, refined by someone who's thought more deeply about investing than almost anyone alive, and proven to work over and over. You can put 90% in stocks, 10% in bonds, and then go live. Go travel. Go spend time with people you love. Go pursue the things that matter. Go be present for your remaining years instead of constantly worried about money. The market will go up and down. That's guaranteed. Some years will be spectacular. Some will be terrible. But over 20 years, over 30 years, the direction is clear. Businesses create value. Innovation happens. Problems get solved. The economy grows. Not smoothly, not predictably, not without terrifying moments, but it grows. Buffett's 90-10 rule is a bet on that growth. It's a statement of faith in human ingenuity and economic progress. If you believe the world will keep moving forward, that people will keep building and creating and solving problems, then 90% stocks make sense. You're just participating in that progress in the simplest possible way. History suggests the pessimists have always been wrong eventually. The optimists who stayed invested, who stayed patient, who refused to let fear win, they're the ones who ended up okay. Buffett is 94. He's lived through World War II, the Cold War, the assassination of presidents, the Great Inflation, the dot-com crash, 9/11, the financial crisis, a pandemic. Through all of it, his response has been the same. Stay invested, stay patient, trust the process. He's not telling his wife to do anything he hasn't done himself for 7 decades. That consistency should tell you something. This isn't theory. This is the documented behavior of someone who's seen everything and still believes in the same principles he started with. The 90-10 rule isn't complicated. It's not clever. It's not exciting. It's just effective. Effective because it's simple. Effective because it removes emotion. Effective because it's based on fundamental truths about how wealth is built and preserved over time. You don't need to be Warren Buffett to use it. You don't need his intelligence or experience. You just need his discipline, his patience, his willingness to trust a sound process even when it's uncomfortable. That discipline is available to anyone. It costs nothing. It requires no special knowledge. It just requires a decision and the strength to stick with it. So maybe that's the real question, not whether the 90-10 rule is right for you, but whether you have the discipline to follow any strategy consistently for the rest of your life. Because the best strategy in the world is worthless if you abandon it at the first sign of trouble. Buffett knew this when he wrote those instructions. He wasn't just passing down an asset allocation, he was passing down a philosophy, a way of thinking about money and time and patience and fear. The philosophy says, you have less time than you think and more time than you fear, so act accordingly. Don't be so cautious that you guarantee poverty. Don't be so aggressive that you can't sleep. Find the balance that lets you stay invested through everything that's coming. 90-10 is his answer to that balance. Maybe it's yours too. maybe it's not. That's between you and your situation. But before you dismiss it, ask yourself this: am I rejecting it because it's actually wrong for me? Or because I'm afraid? Because I don't think I have the discipline? Because it challenges everything I've been told? Those are different questions with different answers. Buffett has spent his entire adult life answering them. The 90-10 rule is what he landed on after 90 years of thinking about money, markets, and mortality. That should count for something. Somewhere in Omaha, a 94-year-old man is probably reading an annual report, thinking about businesses, living exactly the same way he has for 70 years. His portfolio hasn't changed, his discipline hasn't changed, his belief in patience hasn't changed. The world has changed around him, but the principles haven't. Maybe that's the final lesson. Not about specific allocations or perfect strategies, but about finding something true and holding on to it. About making decisions based on decades of evidence rather than weeks of headlines. About trusting processes over emotions. Retirement is long. Longer than most people think. Long enough for patience to matter. Long enough for discipline to compound. Long enough for simple strategies to prove themselves. You have time. More time than you fear, just maybe less time than you think. And in that tension lives the entire challenge of these years. Warren Buffett looked at that tension and found clarity. 90% stocks, 10% bonds. Simple, disciplined, patient. Proven, the rest is just noise. And noise is exactly what you don't need. What you need is peace, confidence, a plan you can believe in, permission to stop worrying and start living. That's what this rule offers. Not perfection, not certainty, not safety from every possible bad outcome. Just a sound approach based on everything we know about how markets work over time. A strategy that survived every crisis of the last century. A philosophy that values patience over cleverness and discipline over activity. It's enough. It's always been enough. And for those with the courage to embrace it, it always will be.